The trade war is back. After a brief respite, tariffs are once again front-page news. The Trump administration has unleashed a wave of new tariffs, targeting China in particular. These tariffs are already having a significant impact on the global economy, and the situation is likely to deteriorate further in the coming months. The stated goal of these tariffs is to protect American jobs and businesses from unfair competition. The Trump administration argues that China has been engaging in unfair trade practices, such as intellectual property theft and currency manipulation. These practices, the administration claims, have cost American jobs and hurt the economy. However, many economists argue that tariffs are a blunt instrument that is likely to do more harm than good. They point out that tariffs raise prices for consumers and businesses, and that they can lead to retaliation from other countries. In the long run, tariffs are likely to hurt the very people they are supposed to help. The current trade war is already having a negative impact on the global economy. Businesses are facing uncertainty, consumers are paying higher prices, and stock markets are volatile. If the situation continues to escalate, it could lead to a global recession. The recent escalation in the US-China trade war began in earnest in early 2025. In February, the Trump administration announced that it would be ending the de minimis exemption for low-value shipments from China and Hong Kong. This exemption had allowed businesses to import goods worth up to $800 without paying any tariffs. The move to end the de minimis exemption was met with swift condemnation from businesses, who argued that it would lead to higher costs and increased bureaucracy. The administration initially suspended the plan, but it was ultimately implemented in May. In addition to ending the de minimis exemption, the Trump administration has also imposed a number of other tariffs on Chinese goods. In April, the administration announced that it would be imposing a 10% tariff on all U.S. imports, including those from China. This was followed by the imposition of 125% tariffs on Chinese goods due to the fentanyl trade. China has retaliated against the U.S. tariffs with tariffs of its own. The country has imposed tariffs on a wide range of U.S. goods, including soybeans, pork, and automobiles. The trade war has led to a significant decline in trade between the two countries. One of the key arguments that the Trump administration has made in favor of tariffs is that they will generate revenue for the U.S. government. However, the reality is that the revenue generated from tariffs has fallen far short of the administration's claims. In April 2025, the U.S. earned $285 million in customs and excise taxes. This brought the total revenue generated from tariffs in April to just over $16.1 billion. While this may seem like a significant amount of money, it is important to put it into context. The Trump administration has repeatedly claimed that tariffs are generating billions of dollars per day in revenue. However, the actual figure is closer to $192 million per day. This is a far cry from the $2 billion per day that the administration has claimed. The shortfall in tariff revenue is likely due to a number of factors. First, businesses have been able to find ways to avoid paying tariffs, such as by rerouting their shipments through other countries. Second, the tariffs have led to a decline in trade between the U.S. and China, which has reduced the amount of goods that are subject to tariffs. While the Trump administration has argued that China is paying for the tariffs, the reality is that it is American consumers and businesses who are bearing the brunt of the costs. The tariffs have led to higher prices for a wide range of goods, from clothing and electronics to automobiles and food. The average U.S. tariff rate is now at a century high of 28%. This means that businesses are paying an average of 28% more for goods that they import from China. These higher costs are being passed on to consumers in the form of higher prices. For example, the price of a washing machine has increased by an average of $86 since the tariffs were imposed. The price of a car has increased by an average of $5,800. And the price of a can of beer has increased by an average of 10 cents. These price increases are having a significant impact on American households, especially those on lower incomes. The tariffs are estimated to be costing the average American household $831 per year. Section 5: Industrial fallout, job losses, and supply chain chaos. In addition to raising prices for consumers, the tariffs are also having a negative impact on U.S. businesses. Businesses in a wide range of industries are being hurt by the tariffs, but some of the hardest-hit industries include manufacturing, agriculture, and retail. The tariffs have led to job losses in a number of industries. For example, the auto industry has announced tens of thousands of layoffs in recent months. These layoffs are a direct result of the tariffs, which have made it more expensive to produce cars in the United States. The tariffs are also disrupting supply chains and creating uncertainty for businesses. For example, the end of the de minimis exemption for low-value shipments from China and Hong Kong is expected to lead to significant delays and disruptions in the shipping industry. The trade war is also hurting U.S. farmers who are facing retaliatory tariffs from China on a wide range of agricultural products. China was once the largest export market for U.S. soybeans, but exports to China have plummeted since the tariffs were imposed. Section 6. A sea of red stock market volatility and investor fear. The ongoing trade war between the United States and China has injected a significant degree of uncertainty and volatility into global stock markets. The Dow Jones Industrial Average, the S&P 500, and the Nasdaq Composite have all experienced sharp swings in recent months as investors react to news about the trade war. The uncertainty surrounding the trade war is causing businesses to delay investment and hiring decisions. This is further slowing down economic growth and contributing to the stock market volatility. Investors are concerned about the long-term impact of the trade war on corporate profits and global economic growth. The trade war is also contributing to a decline in business confidence, which is further weighing on stock prices. Section 7. A world in retaliation, global trade tensions escalate. The ongoing trade war between the United States and China is not just a bilateral issue. It is having a ripple effect throughout the global economy, leading to increased trade tensions between other countries. The European Union, Canada, Mexico, and other countries have all imposed retaliatory tariffs on U.S. goods in response to the Trump administration's tariffs on steel and aluminum imports. These retaliatory tariffs are hurting U.S. businesses and contributing to the slowdown in global economic growth. The trade war is also undermining the rules-based trading system that has underpinned global economic growth for decades. The World Trade Organization, or WTO, is struggling to cope with the increase in trade disputes. Section 8. The U.S.-China trade imbalance, a looming crisis. At the heart of the trade war between the United States and China is the large trade imbalance between the two countries. The U.S. has a trade deficit with China, meaning that it imports more goods from China than it exports to China. In 2024, the U.S. imported $440 billion worth of goods from China, while exporting only $145 billion to China. This resulted in a trade deficit of $295 billion. The Trump administration has argued that the trade deficit with China is evidence that China is engaging in unfair trade practices. However, economists generally agree that trade deficits are not inherently bad. They can be a sign of a strong economy, as they indicate that consumers and businesses have the purchasing power to buy goods from abroad. While the trade deficit with China is a complex issue with a variety of contributing factors, the Trump administration's tariffs are unlikely to solve the problem. In fact, they are likely to make the situation worse by raising prices for consumers and businesses and harming U.S. exporters. Section 9. Conclusion. The uncertain future of global trade. The ongoing trade war between the United States and China is having a profound impact on the global economy. The tariffs are raising prices for consumers, hurting businesses, disrupting supply chains, and increasing uncertainty in the global economy. The trade war is also contributing to a rise in protectionist sentiment around the world. This is undermining the rules-based trading system that has underpinned global economic growth for decades. It is still too early to say what the long-term impact of the trade war will be. However, it is clear that the tariffs are a drag on the global economy and that they are increasing the risk of a global recession. The future of global trade hangs in the balance. If the United States and China are unable to resolve their differences and de-escalate the trade war, it could have devastating consequences for the global economy.